Hello viewers, I hope you all are good and must be enjoying my videos. In today's video, I'm going to explain another important concept of financial accounting that is of great practical importance. This concept is a financial ratio that is called Return on Capital Employed or ROCE. The first question that may come into our minds is what is the importance of ROCE, implying why we calculate it. Well, the simple answer is that people who invest their money in a business are interested in the return the business is earning on that capital. Expressing this return in the form of a ratio enables comparison with other possible investment opportunities so that the investor can make an informed decision. This ratio is a key measure of return. It measures the amount of earnings generated per $1 of capital and is usually stated as a percentage. The ratio can be calculated in several different ways according to the information required of it and depending on what is meant by the two terms, capital employed and return. First, we'll look at the term capital employed. It can consist of total capital employed, shareholders' funds only, that is including preference share capital, or equity capital only, that is ordinary shares plus reserves. In using total capital employed, we include long-term loans as well as shareholders' funds. Furthermore, it is more correct to use the average of capital employed during the year, as the profit has been earned throughout the year. The capital at the start of the year will have been different, having been affected by share issues and the addition of profit for the year. Now we'll look at the concept of return. As a matter of fact, return is another way of describing net profit. Net profit can be taken to be before or after taxation, and it can also be taken before accounting for interest on long-term loans. The net profit figure to be taken will depend on which figure is taken for capital employed. If capital employed is taken as being total capital employed, then it is the operating profit figure which is required to be used as the return, as this is the profit available to finance the total investment in the business. There are several possible calculations, but the two most commonly used formulas for ROCE are: the first formula is net profit before tax and interest, that is also called operating profit, divided by average capital employed by shareholders and lenders, and then we multiply the result by 100. This expresses the profit which is available to all providers of the long-term capital as a percentage of that capital. The second formula is net profit before tax but after interest, and we divide it by average shareholders' funds, and the result is then multiplied by 100. This expresses the profit which is available only to shareholders as a percentage of their funds. The calculation is also known as return on net assets, as the total capital employed figure is equal to net assets. Now we use the following financial extracts of a company to demonstrate the calculation of return on capital employed. This financial extract has two components, the income statement component and the balance sheet component. The income statement component provides information about operating profit of $9,100, interest on loan of $450, net profit before tax of $8,650, and net profit after tax of $7,650. The balance sheet component provides information about shareholder funds of $18,250 and long-term loan of $4,500. That makes a total of $22,750. Now we can calculate the return on capital employed by applying both the formulas one by one. In the first formula, we can calculate ROCE by dividing operating profit of $9,100 with average capital of $18,925 and by multiplying the result with 100. As the component of this formula suggests, it may be of interest to both the shareholders and the long-term creditors of the company. It may be noted that the value of average capital is calculated by adding the opening and closing capital and by dividing it with 2 as shown on the screen. How we are going to interpret the ROCE of 48%? It simply tells us that the investment in this company is generating a profit or return of 48 cents for each dollar of investment. This can be compared with other investment opportunities to see if this investment is financially viable or not. If other investments can provide a higher return than 48%, then you may prefer those investments and vice versa. Then an important point to remember. So you need to keep in mind that capital employed will include shareholders' funds as well as long-term debts. However, overdrafts are specifically excluded from capital employed. This assumes that overdrafts are temporary and are not considered to be a source of permanent finance for the business. In Formula 2, we can calculate the ROCE by dividing the figure of net profit before tax and after interest of $8,650 with the average shareholder funds of $14,425 and by multiplying the result with 100. As the component of this formula suggests, it may be of more relevance to the shareholders than the long-term creditors of the company. It may be noted that the value of average shareholders' funds is calculated by adding the opening and closing shareholder funds and by dividing it with 2 as shown on the screen. How we are going to interpret the ROCE of 60% in this case? It simply tells us that the investment in this company is generating a profit or return of 60 cents for each dollar of investment. This can be compared with other investment opportunities by the shareholders to see if this investment is financially viable or not. If other investments can provide a higher return than 60%, then you may prefer those investments and vice versa. If it is not possible to calculate the average capital employed, then use the closing capital figure. But bear in mind that it may not be representative of the capital employed throughout the year. If you have enjoyed this video, then please don't forget to subscribe to my channel and also share and like this video. Thank you for watching.